Saturday, September 7th, 2019, Maneco 64, home of alternative economics and contrarian views. Before I start today, I'd like to point out that when I talk about the markets, precious metals, stock market, currencies, anything else, it's my opinion. And when I look at charts, the prospects for securities, for metals, it's also my opinion. I'm trying to help other people understand how markets work. I'm not trying to give them advice about what to do. I always tell people that they need to do their own homework and make the decisions for themselves as far as investing is concerned. And also, I get a lot of people asking me in the UK, my viewers, where can I buy precious metals? And that's why I've put up promo codes for gold investments, who I've been buying bullion from since 2002. Promo code is maneco64. I've also put up a promo code or referral code for Glint Pay, which is basically a way to store gold in Switzerland and at the same time have a MasterCard where you can spend that gold anywhere in the world. And they've given me also a referral code or promo code Mario Glint 79. Glint Pay is an app, so it's the Glint app. So yeah, that's what I'm here for. I'm here also to tell you about my experiences in the city of London in finance. My background, of course, is in finance. I started out in a small portfolio managing firm or private bank in Geneva, Switzerland in the late 80s. And then I moved to the city of London in the early 90s, worked in the city till 2012. So yes, that's my background. I also have a degree in international relations with an emphasis in economics, a BA degree. My professors wanted me to do a master's at the time, and I said, no, I want to go to work, try to get a job. Anyway, I wanted to clarify that first. So today, this Saturday, I'm going to talk about how the biggest bank in the United States and the biggest fund manager in the world, which happens to also be an American fund, are actually advising their clients pretty much for the first time to actually hold gold. And I'm going to go through two blogs from these institutions. Also want to go through a little article that Greg Mannarino wrote on Steemit about Larry Kudlow, who used to be the CNBC's economics cheerleader. He's now a cheerleader for the Trump administration. He's the chairman or economic advisor to President Trump, Larry Kudlow, who, by the way, even worked for the New York Fed when he started out. So you've probably figured out what bank that is that's advising their clients to actually hold gold as a currency. Well, it's JP Morgan, and it's JP Morgan Private Bank. What's the difference between JP Morgan Private Bank and the normal JP Morgan Chase Bank? Well, JP Morgan Private Bank, their clients are usually high net worth individuals, families. So this is not information that is going to be given to day-to-day people that have a checking account or a savings account with JP Morgan Chase. So this came out months ago already. I have spoken about this story or this investment strategy that came out from JP Morgan Private Bank a few months ago. But I'm putting it together now because the biggest fund manager in the world is Blackrock. And 2 days ago, Rick Reeder, who's the chief investment officer of Global Fixed Income, came out with another very interesting article called The Monetary Policy Endgame. And this is also in the Blackrock blog. So let's first start with the JP Morgan piece. So this is from Craig Cohen. and it's called, "Is the Dollar's Exorbitant Privilege Coming to an End?" This, of course, is a comment made, I think it was by, was it Giscard d'Estaing, who at the time was the finance minister of France under de Gaulle. This is what he said, because the U.S. was still under the Bretton Woods system of gold exchange system. And the French knew that the Americans were printing too much money. They didn't have enough gold backing for it. So he called it the exorbitant privilege. So JP Morgan is using that, which is quite significant. This is the kind of stuff I'd be talking about already, like 15 years ago. So JP Morgan is now having to admit that as well. Says the US dollar could lose its status as the world's dominant currency. How does this affect investors? So I'm not going to go through the whole article. I'm going to put a link below in the description to the video already done about this, and it's going to go up in the cards as well. You can watch that. Lo and behold, at the end of the article, this is the new FX exposure that JP Morgan advises its clients, JP Morgan Private Bank. And why do they need an FX exposure? Don't you just hold dollars? No, these high net worth individuals or clients for JP Morgan Private Bank, they're all over the world. Foreign exchange and currencies are very important to them. So this is the previous exposure here. You can see the blue bar is US dollars. It's most of the holding here, 80%. Then you've got the euro, and then you've got actually Japanese yen. You've got the green there, Canadian dollar. You've got Swiss francs, and then you've got actually it looks like it's the, what is it? I think it's British pounds. And now their new recommended currency exposure, well, the dollar drops to 40%. That's a huge drop. And then the orange, of course, is the euro. You've got the gray there for actually light gray for British pounds, which is quite interesting. That's gone up quite a bit. Maybe because the pound has gone down so much, they expect it to stabilize. Who knows? And then the Japanese yen. But the most interesting ones are at the top of this bar. As you can see, XAU is the very dark blue. That's gold, which was not there before. I know that it's not a big percentage, but it's quite significant that they're putting gold there. And they've got the Chinese currency as well there, CNH, which is the dark gray. So yeah, they think it's going to be a multipolar world in terms of currencies, and that the Chinese currency is going to be more important, and also precious metals or gold, of course. So now to BlackRock. I saw this, and I'd like to thank Tom from Belgium. He sent me this about BlackRock, and that's why I try to read all my viewers' messages. Sometimes I get some good tips from my viewers. I do read a lot every day about markets and everything that's going on, but sometimes I miss stuff. So yeah, he sent me this. Thank you, Tom. This is BlackRock blog. Rick Reeder. This is the guy as well, I think I spoke about a few weeks ago, who wrote an article, editorial in the FT, advising the ECB to start buying stocks, right? So I'm going to go through this a little more. So he's talking about, this was 2 days ago, the monetary policy endgame. I've read through this. Basically, he's saying that, yeah, the central banks are running out of ammunition. They're not able to keep their 2% inflation target, which of course I think is rubbish because the currencies have been debased so much. Do you really... Are you really trying to tell me that things are a lot cheaper nowadays than they were 10, 15 years ago? Of course not. This is all about these banks and fund managers keeping asset prices elevated, but I'm just gonna go through what they're saying. It doesn't really matter there. That is a fallacy. The fact is, the conclusion that they come up to is similar to what I've been saying and others in the alternative media have been saying. And basically he's saying that central banks are going to have to, he says ECB has a little bit of room to cut more into negative. The Fed eventually will go to negative. That's his view, or very close to zero, and that they'll have to do more and more money printing, and that all that's going to do is create the debasement of the currency. It's going to be a race to the bottom by all the fiat currencies. So I'll go through the implications of this, the investment implications. This is from Blackrock, biggest fund manager in the world. So it says, how should one position for such an endgame? As is probably evident, any nominal instrument will be devalued in real terms. So the solution is to hold on an asset that maintains its real value, an asset that cannot be printed. We would include stocks. Well, there you go. I'm not too sure about that, but I'm going to read through his reasoning. Dividend yields are set on payout ratios. Companies have some degree of pricing power, and shares outstanding are limited in number. That's true. And I've read recently that I think it was Apple, they've issued $7 billion in bonds. What does that mean, issuing $7 billion in bonds? Well, that means they're borrowing money very cheaply. And what are they doing with that money? I'm not sure. I haven't read through it, the details, but I would say a lot of that is going to go to buying back stock. So yeah, that's right. It looks like these companies are taking back stock or shares from the market. So yeah, it's going to be limited. They're not going to print it. They're actually going to be retiring it. Real estate. And he says it is difficult and expensive to expend the stock of real estate. I agree. And even commodity currencies like gold. Again, limited supply and expensive to extract. Very right. By definition, the worst asset to hold would be a sovereign bond with a negative yield, closely followed by paper money at zero yield, both with a theoretically infinite supply. That's right. The only thing I'd say about sovereign bonds, though, is that as a trading instrument for speculators, while yields are dropping, prices are rising, especially for the longer dated bonds. You get what's called convexity. The prices, as the yield drops, the price rises even faster. It's like the law of convexity, right? Goes on to say, unfortunately, such extreme devaluations in currencies could not only inflate the prices of real assets, but could also push Gini coefficients to historically wide levels, a measure of the rich-poor divide. Yeah, that's right. And may well fuel a continued rise in populist politics. Ultimately, this could have a real influence on central banking as we know it today, and or the value of fiat currency. Interesting that he uses the term fiat currency. 5, 10, 15 years ago, no one ever used that term, fiat currency. I did. All of this is very difficult to anticipate in terms of the breadth and influence of these types of actions and ultimate reactions in terms of how prices, markets, investors, and central banks consequently adjust. I agree. It's going to be something that we've never seen before. And he ends by saying the following. Coming back from these extreme policies is very difficult, particularly as the aging demographic and concurrent potential growth trends embedded in the system provide a ceiling on above trend growth, which otherwise could aid the economy in soft landing from these policies. And potentially, more importantly, extremely low rates can and will encourage fiscal actors to add more and potentially dramatically more debt to an already historically levered set of economies. For example, the increased discussion of MMT. Hence, all this leads one today to consider assets that can participate in an inherent devaluation of the local currency, which is to say, equities, real estate, and even hard assets that have historic value reference, such as gold. I like the fact that they call gold historic value reference. What does that mean? Well, it means that gold for thousands of years has been a reference of value, not paper money. So this is coming from very mainstream institutions, globalist institutions, I would say. I think it's Larry Fink, the CEO of Blackrock. Well, he goes to Davos every year. He's out there. JP Morgan as well, of course. Jamie Dimon, one of the top globalists out there. So these people are actually advising their high net worth clients to go into precious metals. What about the recent move in gold the last few days? A lot of people are asking me, where should I get in gold? At what price, in pounds or dollars? Well, it's very difficult to say where gold's going to bottom or if we're going to keep correcting. Personally, I try to accumulate gold when I have extra fiat reserves, fiat or local currency reserves that I know I won't need to use in the near future. And that's what I think about. Yeah, maybe try not to chase, buy gold when it's at a 6-year high or something like we've been recently. So maybe now it's a good time to dip in. I'm just telling you my opinion. I'm not advising anyone to do anything. But you can see that these big institutions, JP Morgan and Blackrock, are actually advising their client to get into precious metals. They know what's coming. They know that it's going to be a race to the bottom for the national currencies. Yes, they're advising them to hold stocks as well. That's for you to decide, not me. So now before I finish, I want to go through a little piece that Greg Mannarino wrote on steemit.com, very short. So it says The Horrifying Record of Larry Kudlow by Gregory Mannarino. Larry Kudlow's record. Kudlow recommended buying stocks in September 2008 and denied there was a recession on the horizon. Kudlow denied the existence of the housing bubble. In July 2008, Kudlow said it was mental recession, not an actual recession. So yeah, I listened to Larry Kudlow recently. He was talking, I think, CNBC or one of the mainstream media outlets. And he said that the economy was doing great, that that President Trump was transforming, was a transformational president for the U.S. economy, and that America would have 20, 40 years, generations of, how can I say, prosperity. Never mentioned the fact that America, and not only America, I'm not trying to bash America or anything, but America and the rest of the world are drowning in debt, right? Never mentioned the debt and the deficit that America and all other countries are running, right? So there you go. I thought that would be an interesting thing to end on, Greg Mannarino's view of Larry Kudlow. If you enjoyed this video, make sure you hit the like button. Make sure you hit the little notification bell above as well to be notified of my new videos. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great start of the weekend. Take care. Bye.